Hey, welcome back. I'm Merhawi from Bahli Financial Consulate, and this is our weekly conversation on global commodities, trade routes, and the accounting frameworks that connect all of it to your financial statements and your business. This week, we're talking copper, specifically the copper price outlook for 2026, and why the most important deadline in the global copper market is less than 30 days away. We are going to trace copper's price history from the pandemic crash to today's near record levels. And at every major milestone, I want to show you exactly what that price meant for real people, builders, manufacturers, consumers. Then we are going to get into the accounting. How do you value inventory and hedge your exposure when copper is this volatile? And what does IFRS 18 mean for how companies have to present these costs going forward? And we will map out the global trade routes copper travels. There are several, and explain in concrete terms what happens to your costs when those routes break down. Before we get into it, everything we discuss today is for educational purposes only and should not be taken as investment, legal, or accounting advice. Always consult a qualified professional for decisions specific to your situation. And if any of this lands close to home for your business, do not sit on it. Reach out directly at bahlifc@gmail.com. We are a boutique consulting firm, and we genuinely enjoy digging into the specifics with people. All right, let's get into it. The copper price outlook for 2026 is one of the most talked about topics in global commodity markets right now, and for good reason. Copper is trading at roughly $6.45 per pound as of this week. That is up more than 30% year over year. And the thing that is really driving conversation in the market is not what already happened. It is what happens on June 30th, 2026, when the U.S. Commerce Department must hand a report to the White House recommending whether to expand copper tariffs even further. That deadline is shaping everything right now: how companies are buying, how they are stocking up, and what they are paying. We are going to get there. But first, let me give you the context, because the copper price history of the last 6 years is one of the best stories there is about how macroeconomics actually shows up in people's lives. So, what is copper and why do we care? Copper is the metal that runs through virtually every building, every car, every data center, every power grid, and every renewable energy installation on the planet. A typical 2,000 square foot house needs around 400 to 500 pounds of copper in its wiring, plumbing, and HVAC system. A single electric vehicle needs roughly 180 pounds of copper, about 4 times the copper content of a conventional gasoline car. A data center of the scale being built for AI infrastructure today requires hundreds of tons. When copper gets expensive, everything you build, drive, or plug in gets more expensive. That is why people call it the metal with a PhD in economics. It tends to know things before the rest of the market does. Now, let me walk you through the copper price history, because this is where the human story lives. In March 2020, copper crashed to $2.17 per pound. The world went into pandemic lockdown. Factories across China and Southeast Asia stopped. Mines in Chile and Peru sent workers home. Electrical contractors in the US had zero jobs because no one was building anything. Copper wire distributors watched their inventory value drop overnight. It was brutal. Then the recovery happened, and it was fast. By May 2021, copper was at $4.70 per pound. Chinese infrastructure stimulus flooded the market. Shipping was in chaos. Everyone in the US was renovating their homes at the same time. The copper wiring in a new home build jumped in cost by $3,000 to $5,000 compared to pre-pandemic. Plumbers raised rates because copper pipe costs had surged. Car manufacturers started flagging EV production constraints. That was the first real signal that the world was structurally short of copper. In 2022, Russia invaded Ukraine, commodity prices spiked, and then the Federal Reserve hit the economy with the fastest rate hike cycle since 1980. Copper pulled back because growth fears dominated. But here is what was interesting: the pullback only went to around $4.40 a pound. The floor kept rising. By 2024, we had crossed through the $10,000 per ton mark on the LME for the first time in a sustained way. The driver was AI. The rush to build data centers triggered a realization among analysts that the copper demand story was not just about electrification and EVs. It was about a structural technology shift that was going to require copper at a scale the world was not prepared to supply. Lead times for electrical components stretched from 12 weeks to 26 weeks. Electricians were booking out 6 months in advance for commercial jobs. December 2025, copper crossed $12,000 per metric ton for the first time in history. Pre-tariff stockpiling by U.S. manufacturers was already happening in anticipation of the 50% Section 232 tariff on semi-finished copper products that had gone into effect in August 2025. A typical home builder was now paying roughly $1,500 more per home just from the tariff passed through on copper, before even accounting for the spot price increase. And here is where we are today. 3 things are keeping prices elevated: supply disruptions, including the Grasberg mine mudslide in Indonesia, and China's ban on industrial sulfuric acid exports in May 2026, structural demand from AI data centers, EVs, and grid modernization, and the June 30th Commerce Department deadline that is repricing the market right now. This is the copper supply chain disruption story for June 2026. So you have a commodity trading near record highs with volatile spot prices, a 50% tariff on semi-finished products, rerouting costs from the Hormuz crisis, and a major policy deadline 30 days out. Now let me ask you the question that every CFO, every contractor, and every small business owner in the supply chain should be asking right now. How do you account for all of this? The accounting standards that apply here are IAS 2 and ASC 330. For inventory valuation, IFRS 9 and ASC 815. For hedging, and IFRS 18 for how you present all of it on your income statement. These are not just compliance exercises. The choices you make under these standards will determine your reported profit, your tax bill, and whether you trip a loan covenant. That is about as real as accounting gets. Let us start with inventory, because this is where most small and mid-sized businesses first feel the copper price. Under IAS 2, that is the IFRS standard, you have 2 choices for how to assign cost to your inventory. FIFO, which is first in, first out, and weighted average. Under US GAAP ASC 330, you also have the option to use LIFO, last in, first out. IFRS bans LIFO entirely. That is one of the biggest GAAP versus IFRS differences that practitioners deal with today. Here is why this matters right now. Think about a US electrical manufacturer holding 500,000 pounds of copper. Half was bought in 2024 at around $4 a pound. The other half was bought this spring at $6.50. Under FIFO, when you sell your first batch, you record the $4 cost. Your gross margin looks strong. Under weighted average, you blend the 2 costs and get about $5.25 a pound. Your margin looks moderate. Under LIFO, you record the $6.50 cost first. Your margin looks thin, but your tax bill is lowest. We ran the numbers on just 250,000 pounds sold at today's price. The swing between FIFO and LIFO gross profit is over $600,000. Same physical inventory, same sales price, different accounting method. The numbers are not trivial. Now, hedging. Under IFRS 9 and ASC 815, companies that want to protect themselves against copper price movements can designate derivatives, typically copper futures, contracts on the LME or COMEX, as formal hedges. Under weighted average, you blend the 2 costs and get about $5.25 a pound. Your margin looks moderate. And the accounting treatment lets the gain or loss on the futures contract flow through other comprehensive income, OCI, rather than hitting your income statement immediately. The result is a smooth, predictable copper cost on your P&L rather than the volatility of spot. But here's the catch that matters for small business supply chain costs right now. To qualify for hedge accounting under IFRS 9 or ASC 815, you need formal hedge documentation, and you need to demonstrate ongoing effectiveness. Most small and mid-sized businesses cannot maintain that infrastructure, so their copper derivative gains and losses go straight to the income statement. That volatility is visible. Lenders see it. Covenant tests are based on it. It is worth knowing. And then there is IFRS 18, the accounting standards change that is most directly relevant to this week's tariff and trade route story. IFRS 18 is effective January 1st, 2027, but companies are preparing 2026 comparative data right now. This is the biggest change to income statement presentation in 2 decades. It requires every line item to be classified into one of 5 categories: operating, investing, financing, income taxes, or discontinued operations. And the new mandatory operating profit subtotal means that all of the tariff costs and Cape of Good Hope rerouting surcharges. And the new mandatory operating profit subtotal means that all of the tariff costs and Cape of Good Hope rerouting surcharges in their adjusted figures now have to be clearly presented in the operating category. And if a company communicates a non-IFRS metric to the market, they have to include that same metric in their formal financial statements with a full reconciliation. The free ride on tariff and freight exclusions is ending. Now let us map out how copper actually moves around the world, because understanding the global trade routes is what turns price data into a business decision. The first and most important corridor is the Trans-Pacific route, Latin America to China. Chile and Peru together account for more than 55% of global seaborne copper in all forms. China receives the dominant share. China refines 45% of the world's copper, despite holding only 4% of global reserves. It is entirely structurally dependent on South American concentrates. This route is currently operating, but it is feeling indirect pressure from the U.S. copper tariff. When U.S. futures trade at a premium to London prices, it becomes profitable to divert some Pacific copper from Chinese ports to U.S. West Coast ports, competing with China for the same supply. Peru's new Chancay Deepwater Port, opened late 2024, is also reshaping how concentrates flow across the Pacific. The second critical corridor right now is the Cape of Good Hope route, the Hormuz diversion path. When the Strait of Hormuz effectively closed in late February 2026, every cargo that used to transit through the Persian Gulf rerouted around the southern tip of Africa. The Cape route adds 3,500 nautical miles and 10 to 14 days of transit time on a typical Asia-Europe run. Before the crisis, container freight on major lanes was running around $3,000 per container. Post rerouting, those same lanes jumped to $4,000 to $4,500, a 25 to 35% increase. War risk insurance surcharges add another $200 to $800 per container. For a copper wire manufacturer importing product from an Asian supplier, every container now costs roughly $1,500 to $2,000 more than it did 18 months ago. That is a real quantifiable hit to small business supply chain costs. For this disruption to ease, a ceasefire agreement between the U.S. and Israel and Iran would need to be followed by mine clearance operations in the Strait, which maritime experts estimate could take 6 to 12 months even after an agreement is reached. The signal to watch is whether COSCO resumes its Bandar Abbas bookings and whether war risk insurance starts normalizing. Neither has happened as of this week. The third corridor worth watching is the Panama Canal, currently operating normally, carrying Chilean and Peruvian copper to U.S. East Coast and European buyers. The canal handles roughly 5% of global maritime trade. The forward risk is El Niño. NOAA issued a watch in April 2026 with roughly a 25% chance of a very strong event emerging mid-2026. If that triggers a repeat of the 2023 to 24 drought, which reduced daily canal transits from 38 down to 22 vessels, an electrical contractor waiting on copper from South America could face an additional 3 to 4 week delay on top of already stretched 26-week switchgear lead times. The backup route is Cape Horn, which adds 7,000 nautical miles and 8 to 10 additional days. Connect this back to the accounting. Under IFRS 18, every additional freight dollar from Cape of Good Hope rerouting or a Panama Canal delay sits in the operating category. It is visible. It is not excludable without full reconciliation. If you are a manufacturer with a loan covenant written against adjusted EBITDA, and your lender's definition of adjusted EBITDA was written before IFRS 18, you need to have that conversation with your legal and accounting team before January 2027. The forward-looking signal for next week, the June 30th Commerce Department deadline. That recommendation will tell the market whether refined copper tariffs are coming in 2027. Either way, this is the copper trade investment story to watch right now. All right, let us bring it together. 3 things from today's conversation. Number 1, the copper price outlook for 2026 is shaped by a collision of structural demand, AI, EVs, electrification, and acute supply constraints, including mine disruptions and the China sulfuric acid ban. The June 30th tariff deadline is the single most market-sensitive event in copper right now, and the U.S. copper tariff impact on manufacturers and builders is already visible in margins and lead times. Number 2, the accounting implications of this copper price history are material and immediate. How you choose your inventory method under IAS 2 or ASC 330, FIFO, weighted average, or LIFO if you are under US GAAP, can swing your reported profit by hundreds of thousands of dollars on the same physical inventory. And IFRS 18, which takes effect for 2026 comparatives, means that tariff costs and Cape of Good Hope rerouting surcharges now have to sit clearly in your operating category. That affects how lenders see your margins and whether you trip covenant thresholds. Number 3, the critical minerals supply chain story running through copper is global, and the disruptions, Grasberg, sulfuric acid, Hormuz, the Panama Canal El Nino risk, layer on top of each other in ways that the commodity price outlook alone does not capture. Before we get into it, everything we discussed today is for educational purposes only and should not be taken as investment, legal, or accounting advice. Always consult a qualified professional for decisions specific to your situation. If you want to apply any of this to your own business, whether you are managing copper exposure, reviewing your inventory accounting method, or just trying to understand what these cost increases mean for your margins, drop us a line at bahlifc@gmail.com. We are here for exactly those conversations. If this was useful, subscribe so you get the next conversation the moment it drops every Saturday. Share it with a colleague who is managing commodity costs or dealing with supply chain decisions. This is the kind of context that makes a real difference. And leave a comment. What is the commodity cost story that is hitting your business hardest right now? I want to know. I am Mer Hawi from Bahli Financial Consulate. Thank you for listening, and I will talk to you next Saturday.